All right, looks like we are live. So, yesterday was the press conference for the Fed after the Fed meeting, and Jerome Powell, Fed chairman, said things that President Trump did not like. Also, Dave Portnoy of Barstool Sports, El Presidente, things that he did not like because he went off on a rant today about why his stocks always did not go up. So President Trump tweeted out, I did not fit the tweet on here because there's a lot of different Fed headlines that came out of the press conference, besides just how no interest rates, supposedly there will be no interest rate hikes until 2022. Yeah, right. Even if there is, maybe it's only a couple quarter points. The Fed is trapped at this point. The ECB is trapped. The Bank of Japan has been trapped longer than pretty much anyone. We're all in Japanification now, even though we don't want to be. And President Trump tweeted out earlier today at 11:07 a.m., quote, the Federal Reserve is wrong so often. I see the numbers also and do much better than they do. We will have a very good third quarter, a great fourth quarter, and one of the best ever years in 2021. We'll also soon have a vaccine and therapeutics cure. That's my opinion. Watch. And then I think he marched out either Larry Kudlow or Mnuchin. I think it was Mnuchin this time, although I would not be shocked to see Kudlow out doing the circuits as well on maybe Fox News, Fox Business, Bloomberg, and CNBS, etc. The Fed balance sheet, the official Fed balance sheet did only increased, I think, about $4 billion in the last week, so very little there. There was some big repo spikes this week, but they were only overnight repo. The term repos did not spike big. So let's get into the comments that Jerome Powell made that pissed off President Trump. So there is conflicting information coming out of the Fed. The Hill article that I put up there says the Fed is predicting unemployment will fall to 9.3% by the end of 2020. Federal Reserve officials expect the unemployment rate to remain above 9% until the end of 2020, with the economy shrinking by more than 6% in that time, according to projections released Wednesday. The 17 members of the Federal Open Market Committee, or FOMC, which sets Fed interest rates, projected a median unemployment rate of 9.3% in 2020, falling to 6.5% in 2021 and 5.5% in 2022. The problem here, besides the fake jobs numbers that came out on Friday, and I do have the slide deck. I have to record the audio after this short little live stream show. I have to record the audio. I've not been, again, I've disclosed this already. I haven't been feeling the best for months now because my workout routine and other things are off for, with the lockdown. Gym's not open, not doing my normal amounts of cardio and core work and lower body lifting. Anyways, the unemployment rate was near a 50-year low, 3.5% in February. I don't believe that before it spiked, although a lot of people are probably working 2 or 3 jobs to pay their bills, to 14.7% in April amid closures. But then here we have the other comments that Jerome Powell made that are conflicting. I put that. I didn't see anyone else mention that these are conflicting in 2 separate headlines. From Brian Sozzi of Yahoo Finance, editor-at-large, Jerome Powell to toss some cold water in those giddy Wall Street bulls. On those giddy Wall Street bulls, continuing to cheer the surprisingly upbeat May jobs report that sparked hopes for a V-shaped economic recovery after the worst of the global pandemic. Powell, speaking to reporters following the Fed's latest decision yesterday on rates, said, quote, millions of people will not return to work for some time because of the aftershocks to businesses from the health scare. Well, that doesn't jive with the low unemployment rate predictions. So one of those 2 things are wrong. I'm going to say that Jerome Powell told the truth on that one, that millions of Americans will not, because we're seeing a bunch of stories. Also, the talking heads on the mainstream media, regular mainstream media, local NBC News was talking about their friends, small business owners, were worried about going bankrupt in the next few months. This was on a local news station talking about that. I also on Fox News, Fox Business. I saw it on other channels. People are really worried. There's even a CBS article I may cover that came out in the last day or 2 about impending bankruptcies for small business. The new black swan that a lot of people are not talking about yet, that my real estate investor contacts are talking about, is the commercial real estate black swan that could happen in the next couple months if cash flows do not come back to service with rent and service mortgages. So, and there's also the regular residential real estate problems there of people not being able to pay rent or defaulting on their mortgages. They got forbearance for a number of months, but that forbearance period will run out. And I think that's why Quicken Loans, which is, I think, the largest mortgage company, just is filing for IPO. They're trying to dump those shares out quick. They're trying to get those shares out quick. Also similar, it's not quite as bad as what Hertz's creditors are trying to do. Hertz's creditors are ridiculously trying to dump $1 billion worth of equity in a bankrupted company. They're trying to sell an additional $1 billion to uneducated gambling. I don't think you can call them investors. They may call themselves investors. Please don't go out and buy the Hertz equity that they're selling even though they're bankrupt. Apparently the creditors of Hertz think that they can raise that capital. Sell equity for a bankrupt company. I've never heard that one before. And I've been doing finance for over a decade, working in the financial industry. And a lot of my contacts have never heard that one before, and some of them are bond traders and worked in credit. They've never heard that one before either. We are in a very, very weird, bizarro world, twilight zone, where what is up is down, what is left is right, what is inside is out, what is bankrupt is now rallying type of new normal, at least for a while. We'll see what happens once we get maybe somewhat normal economic activity. I don't know when. Hopefully soon. Oh, and last story here, Mnuchin. Mnuchin says Trump administration will seriously look at sending out more stimulus checks. So according to this MarketWatch article from the DC reporter Victor Reclatius, I screwed that one up. Treasury Secretary speaks at Capitol Hill hearing about what may go in Washington's next global pandemic relief package. Apparently, the scuttlebutt here is that there's going to be more $1,200 stimulus checks coming out by the late July. So that's after people have supposedly paid their taxes, unless they delay that again. But the stock market is starting to roll over for a number of different reasons. The put-to-call ratio, which for weeks now was extremely bullish stocks with lots of people buying calls. Now people are starting to buy puts and hedge. We'll see what happens with Q2 and Q3 earnings data. We'll find out who's really swimming naked when the tide is going out. Okay, got a super chat here from Abbey Road. Thank you for the super chat. When will gold go over 1,800? Let me look at the price right now. Well, I've said on my videos that gold is being intentionally capped below 1,800, so it will eventually go over 1,800. Now, it might take 6 more months, or it could take a couple weeks or month. My portfolio is set up where it doesn't matter. My portfolio is actually set up now in the long run to benefit from paper price manipulation. I figured it out. The more gold prices are capped below a certain price, the more my royalty and streaming companies, the underlying businesses, do more deals for cash flow. I've talked about this a lot, more than anyone else. So I don't really focus on the gold price. If you're a short-term trader, okay, but I don't focus on the gold price. My educated guess, hopefully under 6 months. It should have happened already. But the people in power, I've talked about the details on this in short videos. Did you see what the bank, Ronan Manley? Go and read that Ronan Manley article from, I think it was mid-April. He goes through in painstaking details about how the Bank of England had to bail out HSBC Bank for 170 tons of physical gold. So there was all kinds of shenanigans. I did an interview with James Anderson of SD Bullion, the content manager, content executive, content director, about this. So I don't really care about short-term gold price movements. If the stocks I like, the underlying businesses get cheap again, I want to accumulate more shares. I don't focus on the gold price anymore. This is why I designed my portfolio the way it is. But they're going to run out of physical metal at certain prices because the miners cannot keep producing, silver miners can't keep producing silver below when it was below 15. Okay, anyone who says otherwise, at a certain point, the silver miners were going to run out of physical silver. A lot of copper miners probably are going to go bankrupt in the near future anyway, and that's going to take a lot of silver byproduct offline. So at certain price points, if they cap metals prices at certain price points for a certain period of time, The miners run out of economic metal to mine. There's only so many costs you can cut at the mine, especially when a lot of these cost-cutting measures for the miners, they involve making big, large capital investments. So in order to reduce costs more, sometimes a miner has to spend $50 million or more that they don't have because they can't raise equity, and they already have too much debt on the balance sheet. This happens to miners a lot. And then that's normally when the royalty and streaming companies have to come in with a streaming deal to fix their balance sheets. So I don't focus a lot on the gold price anymore. Thank you for the other super chat, Abbey Road, but you want to see your bullion on a $2,000 an ounce? How long have you been in this market? I've been in this market since 2007 and 8 when I was reading Ed Steer's newsletter, and he was correctly, his email newsletter with Casey Research, and he was correctly predicting all of the gold and silver price smashes. And then back then in 2007, 2008, 2009, and for part of 2010, on big, large paper price smashes, it would take months, sometimes longer, sometimes over 6 months for the price to recover. You know, luckily, I think those days are gone. I think it takes sometimes weeks, if not only a couple months now, for the paper price to recover. Look, they can't cap gold at $1,000 anymore. Most miners cannot produce gold at $1,000 anymore. They can't cap silver at $12 or $10 or $12 an ounce. There's not economic silver at those prices. So it's like James Turk says, it's a managed retreat. They defend a price point for a certain amount of time, and then they have to let it go. That's what it is, in my opinion. So at a certain point, we're going to be over 1,800, and then they're going to fight 1,900 or 2,000, and then at a certain point, we're going to go over that. That's, in my opinion, what's going to happen. So it's a managed retreat. They're defending each like $100 increment. Oh yeah, someone brought up the VIX. We got a big move today in this. VIX popped almost 50%. Dollar index, let me hit the refresh button. The dollar tug of war is still in full effect. A lot of people said the dollar bear market is here, and yet we had a little rally. I think the dollar index got almost down to 96 flat, almost down to 95 in the last couple days, and now it's almost to 97 again. And this is in spite of the U.S. Treasury needing to raise about $3 trillion over the next 3 months? So it was predictable that liquidity was going to come out of stocks because the U.S. Treasury needed to raise that capital. So all that extra liquidity, the Treasury was going to need that for funding. But the Fed is also, there's cross currents. The Fed is also, there's cross currents to this. The Fed is also monetizing that debt. So the market is looking at all these different things. And that's why I think for now, the dollar tug of war is accurate. It's going to go up and down, back and forth for a while. When the dollar goes down, the dollar bears are going to say, see, I was right. And then when the dollar index goes back up, Brent Johnson and Jerome Powell and some of my other friends, I'm still friends with Brent Johnson. I respect him a lot. I just think if the dollar index goes to a certain level, it's going to collapse everything. And the people in power at the Fed, U.S. Treasury, they change the rules. There's nothing to stop them from changing the rules or just sending people larger checks. Congress can do it too. We're in an environment now where, because there's no normal economic activity yet, there's just basically bailouts and rules changes. Oh, and people getting stimulus checks and gambling on bankrupt companies. And according to Jim Bianco, they are worse than tech stocks. According to Jim Bianco, Bianco Research is worse than the technology bubble from mid-90s to 2000. Actually, speaking of that, let me just play some audio clips from Jim Bianco. This is an excellent interview on Jim Bianco's new YouTube channel. Or it's fairly new. It's pretty small. He posts his interviews over there. This is a clip I'll play for a couple of minutes with Jim Grant of Grant's Interest Rate Observer about the yield curve and what the Fed's been doing.
Us have Jim on the podcast to talk about what the Fed is up to now. The Fed's always up to something. So I'm going to begin, Jim, by asking, what is it about the yield curve that makes you think that the handsy Fed is manipulating it?
I think the first answer is if you look at the yield curve, it's been in its surprising lack of movement, and in yields themselves in their surprising lack of movement. Since April 15th, going on 6 weeks or so, almost 2 months. The yield curve is barely moved within 10 basis points plus or minus. The 10-year yield has barely moved 10 basis points plus or minus 65 basis points. So it hasn't moved much. It's gone sideways. Volatility measures like the CBOE interest rate volatility to move index, they're at multi-year lows. If you were to look at interest rates in the lack of...
I'll stop this for a second. The Fed was able for a few months now to smash volatility down. So the leverage short vol traders and the Fed were able to smash volatility, keep it quiet for about the last 10 weeks or so, give or take. And shorting only worked, I think, for overall maybe about 6 weeks or so, give or take, in part of February and part of March. And then the Fed just stepped in and did I call it press release manipulation, because out of all the press releases they issued about all the programs, they actually didn't buy a lot of the stuff for months. They've really only just started buying a little bit in the last 3 or 4 weeks, and it's only a little bit compared to what they guaranteed in the press release. And this is what I talk about with rules changes and the new normal, is look what the Fed's gotten away with. They issue this press release backstopping things, so these large corporations starting in the first week of April, these large corporations can issue record amounts of corporate bonds to yield-hungry investors. So they're capping the yield curve with yield curve control, Japanification, financial repression, whatever you want to call it. They're trying to force people into the stock market, and then they're also able, without actually having to buy all the things that were guaranteed or quote-unquote guaranteed in the press release that they were going to buy, they were able to backstop the corporate bond market and get these large corporations, which already had too much debt on their balance sheet, to either refinance the debt or to raise more bond capital. So that this is, again, parts of the rules change. The rules changes are fast and furious. There's a lot of stuff going on behind the scenes that we may never know about. It's just crazy. Okay, let me just play a few more minutes of this clip with Jim Bianco and Jim Grant. It's good.
Of their movement, you would conclude this is somewhere in the middle of 2019. Everything's fine. There's nothing to see here. There's no reason to move interest rates. It's all good. You would not conclude that we were in the middle of one of the greatest economic stress points in American history, and that the U.S. Treasury Department was on the precipice of delivering $3 trillion of new issuance over the next 3 months.
Let me just pause, interrupt you 1 second, Jim, to put that in perspective. So between 1789 and 1981, the United States amassed its first trillion in gross public debt, 192 years. Mm-hmm. Now we are doing that work in 30 days. Now, is that not progress? This is productivity, gentlemen.
Yeah, it really is. It really is progress. And the yield curve and interest rates themselves are barely reacting to this move. And if you would ask me the question why, I would say if you look at what the Federal Reserve has done with its balance sheet and with its purchases of securities, it has done numbers that are hard to understand. Since the pandemic hit, since the lockdown started, the Federal Reserve has bought just $2.3 trillion with a T, dollars of treasuries in 10 weeks. They've added another several $100 billion of mortgages and agencies, and that doesn't even get into the alphabet soup of things that they're doing with commercial paper and with ETFs and with corporate bonds as well, too. They are buying so many bonds right now that if you were to look at metrics like the Bloomberg Aggregate Bond Market Index, its size is actually shrinking this year. The bond market that is available for private sector investors is shrinking because the Federal Reserve has been hoovering up more than even we've been issuing. Now, the issuance is coming, and I have no doubt that the Fed will be there to help smooth that over. But I think the big reason that you're seeing interest rates being so quiet is we have a de facto yield curve control, a price-fixing mechanism by the Federal Reserve that while they talk about it, and John Williams, New York Fed president earlier this week, said that, yield curve control is something that they're looking at. And I would argue, no, you've actually been doing it for 6 weeks now, and you're going to continue to do it as we move forward from here, that the driving force in the bond market to keep everything stable and quiet has been this almost unlimited ability of the Fed to buy up everything and anything in sight.
Well, this is a new thing under the sun of finance, is it not? I mean, we had yield curve control, of course, during the years 1942, I believe, 1951. 1951, it ended with a so-called accord. The Treasury agreed the Fed could conduct an independent monetary policy. That was 9 years during the war and after the Second World War. But this is something a little new, is it not?
Yeah, this is new in that, in that yield curve control, it was a little bit more indirect. It was the Fed basically helping to set interest rates and issue bonds at a certain rate. This one is them in the market continuously as the single largest player in the market, with the idea of keeping prices as stable as they can. They will buy when markets fall, and they will buy less. They haven't had to sell yet, but they would probably if they need to when markets rise too much, if they felt like they did rise too much. So, yeah, I don't think we've seen anything like this. The closest example we have is Japan. And I think the takeaway that I have about what happened in Japan with their yield curve control, which they instituted in 2016, is it didn't help their economy. It has still struggled along, and it's really hurt their private sector. The amount of volume and activity in their bond market is down by 75% over the last 5 or 6 years. There are whole days that go by in the Japanese government bond market where benchmark issues don't trade one time at all during the day. If you fix the price, eventually that price becomes the wrong price. And while people will recognize it's the wrong price and either want to rush in or buy or sell, there won't be somebody on the other side, and they'll just lose interest in the market because it's not at the right price and they can't transact, and they'll go elsewhere, and you lose all of your liquidity. And that's what's happened in the JGB market, and that is the risk that the Fed has if they want to continue for a long period of time doing this with the U.S. bond market.
Well, there's also a risk of the wholesale mispricing of credit, right? I mean, these interest rates are, after all, prices. They direct flows of resources, and the reason we have uncontrolled prices, supposedly, is that they allocate resources more effectively than do central control regimes. Why don't we call this what it is, which is price control?
It is price control, and if I was to be charitable, I would argue that maybe at the initial outset of price control, that whatever price you fix it at might be somewhere near what we would perceive as fair value. Think Japan setting rates at 0 in 2016. Well, if you leave it there long enough, the economies will change, fundamentals will change, investor preferences will change, but those interest rates or those prices won't change, and they will become out of line with the economic reality. And that's the risk that they will face, is that if you want to fix prices, then you got to fix everything else, and everything else isn't fixed, and nor can it be fixed. And so as the economy bends and folds and shapes and preferences change with investors, 65 basis points will not always be the right price forever and ever. Amen. It will eventually become the wrong price, and that will then create its own set of problems, which I think will probably come a lot sooner than the Federal Reserve is anticipating.
What kind of problems, Jim?
I think the biggest problems are going to be a liquidity problem. I think that players, if you're going to keep prices this low and this stable and watch the economy go on an annualized basis fall 30 or 40% and increase 20% in the third or fourth quarter, if we believe the consensus opinion, and try and issue $3 trillion worth of securities at the same time, but the one constant is they will always be issued at the same price or as close to the same price as we can, regardless of all those ups and downs. At some point, investors will start to realize that those securities are at the wrong price. I don't want to play. They'll leave, and we'll then be stuck with something akin to direct monetization, because the only player left that will be able to buy those securities will be the Federal Reserve itself. Instead of the Federal Reserve trying to direct the private sector to buy these securities at a predetermined price, they'll just leave. That's what's happened in Japan, and then it'll be left up to the Fed themselves to basically buy what the Treasury wants to issue.
Jim, I'd like to go a little bit on...
Okay, the rest he talks about how little the Japanese government bonds trade anymore, but that is the great Jim Bianco Research, a great global macro analyst and a bond expert. I've reached out to him a couple times in the last week or two, trying to get him on for an interview, reached out on Twitter and an email. So if anyone knows him, maybe put in a good word for me. I know George Gammon has interviewed him, so if George is listening to the live stream, maybe George can help me get him on for an interview, ask him some questions. So to wrap things up here, some of the things that Jim Bianco was talking about, and also the comments that the Fed has made, the Fed wants to let, and other people like Jim Rickards and others have said this over the last like 6 to 8 months, even before the global pandemic, the Fed wants more inflation. The Fed is trying to manage a weaker dollar. So the Fed is intentionally trying to keep the dollar weak, because President Trump, I'm sure, is annoying them daily, maybe more than once a day, about it. And then it's inflation, because it is a bias with Keynesian economists, with Keynesian economics, with the Keynesian academics, with the Keynesian central bankers, with the Keynesian central planners, with the Wall Street Keynesians. The bias is for inflation. They're hoping that it won't be too much inflation. They're hoping that they can control it. They're hoping that the inflationary expectations, once inflation gets going, will not increase a lot. Because once those inflationary expectations get going, that's when the velocity of money gets going. That's when people decide that they don't want to hold on to currency. Although people are not really holding on to currency right now, are they? They're buying stocks. They're gambling on stocks with it. A lot of people got those $1,200 stimulus checks, did not pay down debt. They did not put it in savings. They did not think about maybe starting an online business. They gambled with it on call options or $1 stocks or bankrupt companies. So all these things that the Fed announced yesterday in the Jerome Powell press conference, bottom line, Fed not raising interest rates until at least 2022, probably longer than that. They may do a token rate hike here or there if they think that they can knock the dollar down temporarily. It's doubtful that they will do that because, like I said, the goal is weaker dollar. The problem is all these other currencies are also wanted to devalue the dollar. Also want to devalue their own currencies. And the amount of dollar-denominated debt. And that's why we're in a dollar tug-of-war, in my opinion. And I think the dollar tug-of-war can go on for a while. It's gone on for well over a year already. The dollar index has been in a trading range for, I forget the exact amount, but it's over 18 months. Okay, so let me take a look at the Super Chats, and I'm going to get out of here. I got to record the audio for that jobs report video before I get ready for bed. I already had Christopher Irons on. Thank you, though. I may have him on again in the months to come, but I'll get on some guests for some other topics. I'm working on an entrepreneurship guest. We'll see. Working on booking an entrepreneurship guest. Okay, let me see if the last couple super chats, and I'll get out of here. Yeah, Abbey Road, you're waiting for 2,000 an ounce gold. This is something that those of us in the gold and silver market for a long time were used to already. Patience is a virtue here. Anyway, my bullion as an American is not tax advantaged. So I don't view bullion, if you're an American citizen, I don't view it as an investment. It's for savings, insurance, and wealth preservation only. Okay, let me see here. Super chat from Toby Wilson. Thank you, Toby Wilson, for the $8. I appreciate it. Toby Wilson is also a Patreon account contributor. One of over 1,000 now. There is a lot of content behind the paywall. I just put out a new article today with some technical analysis charts on the airline ETF, along with some other fundamental research too below that chart work. Let me just say Dave Portnoy is the Barstool Sports Davey Day Trader Global. El Stool Presidente is his Twitter handle. The guest host on the Call Her Daddy podcast. If you don't like rated R or not for children under 17 or X-rated content, don't listen to that podcast. If you like raunchy college sorority girl fraternity humor, frat humor, it's pretty funny. I listened to part of an episode. So thank you very much to my Patreon account contributors. My over 1,000's growing still pretty fairly well despite the global pandemic and a lot of people having to belt tighten, so that's good. Thank you very much to my monthly PayPal contributors. I got a couple more super chats here. I'll get those in before I go. Hey Jason, what from TP? Thank you for the super chat, $5 Canadian. What mining company ETFs would you recommend for exposure to silver? I remember you saying you don't like First Majestic. This is correct. TP, there are articles behind the paywall. There are specific silver mining articles about the silver mining industry behind the paywall from the last couple months. In general, in my opinion, you have the SILJ, which is a silver miners ETF. The safest silver mining company, and they are not a pure play on silver miner, but the management company was smart, and they bought gold mines a number of years ago, is Pan American Silver. So I think Pan American Silver is a lot safer. Silver Wheaton, it's not called Silver Wheaton anymore because they had to go into gold streaming deals, but Wheaton Precious Metals does own a lot of silver streams. So Wheaton Precious Metals and Pan American Silver would be two safer silver exposures. First Majestic Silver is okay. There are some issues there that I talk about more behind the Patreon account paywall and articles about some of the problems with a couple of their mines. Also some bad acquisitions. They do have two good mines, but there's also some operational problems over the years with the company, meaning that when they talk about what their earnings guidance, their production guidance and earnings guidance is going to be, they normally don't meet it. So you have that. And then the other silver exposure is not really pure plays. There's gold mining ETF, smaller ones where there's silver miners in there. There's also Fortuna Silver. My friend Chris Marchese, he's the mining analyst for GoldSeek now. It's GoldSeek or SilverSeek. I think he's the mining analyst for SilverSeek. So for free, if you want to, there's a couple extensive articles that Chris puts out about some silver miners for free on the SilverSeek website. And I think he put out an extensive article about Fortuna Silver and then maybe also Alexco and Mag Silver recently. So you can take a look there for free. If not, you can go look behind the paywall for $5 a month, which is a very good value, let me say, compared to what a lot of other people charge. There's gold stock newsletter writers that charge like hundreds of dollars per year, and I don't think they have any of the analysis that I have behind the paywall. Wow, we have over 300 people watching and not even 100 likes. Please tap. Oh my God, I screwed that up so horribly. Please tap or like. I screwed that up again. I'm getting really tired. Please hit the like button. I screwed that one up too. Okay, one more super chat from Daniel Ashley. Thank you for the super chat. I appreciate it. He says to upvote this video. So I appreciate it. Thank you everyone for listening. And again, if you do know Jim Bianco and you can help me get the interview, please let me know. I am trying to book a lot of interesting guests for the podcast, mix up the content between a mix of long interview guests, short videos, and live stream shows. There will be a mix of things. Some people won't like some of the interviews, some people won't like some of the short videos, some people won't like some of the live stream shows, and some people are my trolls and don't like anything. But I'm trying to put out an interesting mix of content here about investing in the economy to keep things interesting. And with all the crazy things we have going on now, there's plenty of things to talk about. I don't think we're going to run out of topics. Let's just put it that way. It's only going to get crazier. And now we have Quicken Loans trying to dump their IPO before the real estate bust, the coming real estate bust in the upcoming months. Well, unless, of course, the economy restarts and there's cash flows. Okay, well, that's it for tonight's show. And now I'm going to go record that short video about the jobs report. That was, I think, one of the worst pieces of fake economic data I've seen in a very, very long time. The Friday jobs report that came out that the Republicans, Fox News, the Trump supporters, and President Trump are touting. There's a ton of holes in it. I'm going to go through it in the short video. Okay, everyone, bye for now.